Time now for Better Money Boston. Joel Johnson is managing partner at Johnson Brunetti. And Joel, we have to talk about the stock market, the ups and the downs. And we've been hearing about a bear market. How is that defined?
Well, a bear market is a decrease of 20% in stock prices. And so depending on which index we're looking at, market's either down by 30% or over 20% this year. Again, depending on which index or what stocks that we're measuring in the marketplace. So 20% down, it's had an effect on people's 401ks, on people's retirement savings that's not in 401ks. It's created a lot of fear out there, and a lot of people are reacting now to what's going on.
What about inflation? Can't ignore that.
You can't ignore inflation. We've seen prices double, whether it's in food or gasoline, the things people buy. It's having a negative effect on the economy. So what's happened is inflation not only has caused increases in prices, but it's caused a lot of fear in people's behavior.
What about this increase in interest rates? How does that figure in?
Yeah, well, the increase in interest rates is something the Federal Reserve does to slow down inflation. We don't want inflation to run out of control. It decreases the value or the purchasing power that we have. And so the Federal Reserve will try to decrease inflation by slowing down the economy, which could trigger other negative consequences.
When we look at the ups and downs of the market, all this volatility, how do you manage that?
Well, it's like a roller coaster ride, right? And if you think about being on a roller coaster, you don't like it when you're going down. When you're going up, you feel a little more secure, and that's a little bit like the market. People have to get their emotions out of the market, which is why most people should be, and certainly wealthy people do work with financial advisors, because you sort of need that coach to prevent you from hurting yourself with your own behavior.
We hear the word recession quite a bit. Is that a concern?
It is a concern. If the federal government, again, slows down the economy too much by rising interest rates too quickly, it will trigger a recession, which means slower economic activity, possibly higher unemployment.
All right. Joel, you have a great offer for our viewers today. Tell us about that.
Yeah, so the offer that we have, the book we have today, it talks about market volatility. It's real important that people are aware of what happens when the market's volatile and they don't react. Again, an investor's behavior, Megan, is what really hurts the investor, not having that financial plan. It's so important investors have a foundation of a financial plan.
You can get that book today. Simply go to bettermoneyboston.com. Again, that's bettermoneyboston.com. Our thanks to Joel, and that's this week's Better Money Boston.